Good evening, students. Welcome to the live learning classes organized by Board of Studies, ICAI. Hope you're done the recap of our previous class discussion. I've explained the basic concept of levy and also with respect to exemptions under customs law. Right? Before we start, as a protocol, please confirm you are able to hear me. My audio is clear and also my presentation is visible for all of you. So I'll just wait for a couple of students to confirm and then we'll start with our discussion. Good evening, Mansa. Good evening, Shailesh. Hope you have gone through the previous class discussion. You have read the problems. You have read the recap of test your knowledge from the institute material. Thanks for the confirmation, Shailesh. Good evening, Viraj. So we will start with the second topic for our discussion in customs law. In today's class, I'll take you through this topic called types of duty and classification under customs law. Precisely, we will have entire discussion on this topic called types of duty. Precisely, what all customs duties we have under Customs Act. And this chapter is a very, very interesting topic altogether for the reason this will take you through the finest aspects of the policy making in any law, especially on taxation laws. So let's start with our today's discussion. I'll make you to understand the duties of taxes which are levied under exports and imports. And in the process, I'll make you to understand what all specific duties are levied and purpose behind that particular duty. How the government will formulate the levy of various duty. What are the prevailing circumstances for those duties to be levied? And rights and remedies in the process as the government feels this particular duty has to be levied or not to be levied. In case if there is any aggrieved party or any party who is not happy with the duties and taxes which are levied, what are the remedies available to those parties? And classification rules, these are not there in your syllabus. Just I'll give you a basic overview. The Customs Tariff Act, which has got this classification rules, which will also help under GST law. Right? So as a protocol, I'll quickly make you to recap our previous class discussion, and I have parked few MCQs for our discussion. So just let me insert a couple of blank slides. In the previous class, I have started with basic discussion on the topic called assessment. I have made you to examine few basic definitions. Part of those definitions, we have studied something called customs area, then warehouse, then we had discussed on assessment, and we also have discussed something called territorial waters. Right? These are the basic definitions we have discussed, where I have explained the areas which are forming part of your customs area. Like we have discussed on international courier, export post office, right? Bonded bureaus under respective provisions of customs law. And assessment, which includes your imports, exports, classification, measurement of a particular item, self-assessment, provisional assessment. Then territorial waters, where in case of normal territorial waters, 12 nautical miles I have explained. Also in case of exclusive economic zone, 200 nautical miles I have explained. Then we have seen the basic provision called Section 12, which deals with your levy. I have explained the definition of levy, where customs duty is levied on import and export of goods. In the process of this levy, there is a levy of duty, taxes, or cess under any other law, time being in force. This I have made you to understand. In the process of explaining this definition of levy, I have made you to understand one aspect called import of goods. Import of goods, export of goods. Import of goods, I gave an example in relation to Kochi refinery, where oil which is lost in transit before the container reaches the territorial waters, before the ship reaches territorial waters, there is a loss of some item. On the basis of this particular case law, what is the demand and what did Supreme Court have explained on import of goods? And like when we discuss on section 12, I made you to recollect Ram Parivar. What is that Ram Parivar? Section 13, which deals with pilferage. Section 23, which deals with your loss or damage. And section 22, which deals with your abatement. Now, these are the three connected provisions which we have to remember. When there is a small petty theft, this is after unloading before clearance. Loss or damage, this is after unloading before clearance. And abatement, which is before unloading or during unloading. These are the three provisions which we have to read or which we have to keep in mind in connection with section 12. Here, and in this process, I also have mentioned that these two aspects, there should be a proof or the assessee has to satisfy to the interest of AC or DC that so and so damage or deterioration have not been caused by the intent of the assessee, which is beyond control of the assessee. Then we have discussed jet SAM, float SAM, and derelict, where any ship which is abandoned, which we call as a wreck. Then items which are thrown out because to save the ship, we call that as a jet SAM. Those items which are thrown, which are jettisoned, we call as a float SAM. And that ship which you casted to the bay, we call as a derelict. So these provisions, we have read one more aspect called section 15, where date to determine payment of duty. Payment of duty. Where I have made you to understand the provisions where goods have come for clearance. Goods have come for clearance where I can file bill of entry or entry of vehicle or aircraft into the customs area. Whichever is later, that shall be my date relevant for payment of duty. In case of your warehouse, the day your bill of entry is filed, that shall be relevant. Any other case, the date relevance will be payment of duty. Where we will have this particular third provision, in case of this float SAM, the day when the duty is paid, that shall be the date relevant for section 15. These are the provisions connected with clearance of goods and payment of duty. Also, I have made you to understand provisions under section 20, which deals with your concessional rate of duty. Concessional rate of duty on imports, where there are two connected aspects where goods returned and goods received. Goods returned, this is sale which has come back. I could have sale goods which have come back or re-import of exports, re-import of exported goods. Where we have discussed one example in relation to plant and machinery which was imported. This plant and machinery which carries warranty. I have sent this particular plant and machinery for repair. On receipt of this particular plant and machinery, the notional repair charges to be considered for payment of duty. In case of the regular sale, the benefit of IGST paid or the benefit of duty drawback or foreign trade policy related provisions, such benefit needs to be paid back. And these all provisions consist of some timelines to be complied with. And then goods received for the purpose of repair or reprocessing or rework or from say rework. Now these corrected provisions, there is a time limit of 3 years for the goods to come back, and once the goods have been received in India, within a period of 6 months, I need to export back these goods, where I need not pay any customs duty. In this particular case, we have discussed that identity of the goods to be retained. Identity of goods to be retained. How do we maintain this identity? I have explained the provisions connected with surveyor report. Surveyor report, where this particular gentleman gives a report declaring that these are the goods which have been imported, which have got so and so particular batch number or any particular identity number. These are the provisions connected with concessional rate of duty. Last but not least, we have discussed on exemption related provisions. Exemptions under section 25, where exemptions are general or by way of a special order. My general exemption may be again bifurcated into absolute exemption or conditional. And these exemptions are valid for a period of 2 years. Valid for 2 years from the date of notification ending on March respective year. So I have given a couple of dates to make you understand how this date has to be calculated for validity of 2 years. And this validity of 2 years is an exception where if there is a notification where the government has rescinded that particular notification or government has specified that so and so notification is valid for so and so period of say 3 years, 6 years, 8 years, etc. Also, there are few exceptions to this particular validity where any notification which is issued in consideration of a bilateral treaty between two nations. So there are few exceptions, 5 to 6 points we have discussed, which are running beyond this particular time limit. In case of special order, this is by considering a particular scenario in the interest of public so to do, where a specific exemption will be given with a direction. And in the process, we also have studied that this particular exemption notifications can have circular, and this particular circular is valid. This circular can be issued within a period of 1 year from the date of notification. From the date of a notification. And this circular is to clarify the interpretation issues. And the impact of this circular is retrospective in nature. When a circular is given, this circular will have a weightage as if the day the notification came into picture, from that particular day, this particular understanding or clarity, it comes into exist. These are the basic provisions which we have discussed in our previous class. Now, what we will do, I have marked some MCQs for our preparation purpose. Hope you are able to see my screen, students. Hope you are able to see my screen. There's one question from Mansa. So do we need to read judicial decisions on scope of exemption, which are given in our study material? Mansa, this is only out of interest to give more clarity, there are a few students who travel in depth how a particular exemption notification has been brought in, under what grounds this particular exemption notification has been challenged, and how did the tribunal make the interpretation, what did the final verdict of Supreme Court has been given. To give more clarity, these case laws are given as a citation. So my suggestion would be, read them for the purpose of understanding. Examination, there is no hard and fast rule that you need to remember these particular case laws. Okay. Now, let's have a read through of this particular MCQ and let us mark our answer for each of the questions based on our yesterday's understanding and today's discussion. Question number 1. For computing value for reimportation of goods sent for repairs abroad, following expenses are relevant. Point number 1. Value of material used in the repairs done abroad. Freight and insurance from abroad to India. Fair cost of repairs incurred but not paid. Insurance and freight both the ways. Insurance and freight both the ways. Options given. Point number 1 alone. Point number 1 and 2 alone. C. Point number 1, 3 and 4. D. None of them. I'll give you 2 minutes. Take your time. Read the institute material. And give your answer. I'll just pause my video for a minute. I'll give you 2 minutes. Just work out and give your answer. I could see a couple of answers. Shailesh says A, Mansa says B. Please refer your institute material. Let me draw your attention to the respective page. Page number, page number 1.12. Goods other than serial number 1, duty of customs, which would be leviable if the value of reimported goods after repairs were made up of fair case cost of repairs carried out, including cost of materials used in the repair, whether such costs are actually incurred or not, insurance and freight charges, both the ways. So here they have suggested that fair cost of the goods, which are whether or not paid, and also insurance and freight, both the ways. Now let's come back to our answer. Value of material used in the repairs done abroad. Answer would be yes. Point number point number 1 is relevant. Then freight and insurance from abroad to India. Freight and insurance from abroad to India. So this is talking only from abroad to India, but not talking about India to abroad. So probably this point number 2 is incomplete. Clause 3, fair cost of repairs incurred but not paid. So along with material, along with that point number 1, point number 3, even repair charges should also be taken into consideration. Point number 4, insurance and freight both the ways. Answer is yes. All 3 have to be taken into consideration. So what is the odd one out? Clause 3 is odd one out. So this clause 2 is odd one out. So answer would be 1, 3 and 4. C would be the right answer. C would be the right answer. Hope this is clear, students. Let's go on to the next question. Second question. Goods re-imported which are manufactured in India for repairs should be allowed for import without payment of customs duty. Without payment of customs duty shall be permitted if the goods are imported within 3 years of export other than Nepal and Bhutan. If the goods are imported within 2 years other than Nepal and Bhutan. If the goods are imported within 1 year of export other than Nepal or Bhutan. So what would be the right answer? Within how many years the goods should be imported? Is it 3 years, 2 years or 1 year? What would be our answer? My answer, C revised answer, yes, correct. So for this question number 2, what would be your answer? Good evening, Namrata. One MCQ is over. Second MCQ we are discussing, which is on the screen. Others, please give answer for this second MCQ. Shailesh says A. Okay. Straightforward provision. Shouldn't take much time. Examination. Please keep in mind, we have 25% marks for customs law, of which at least 4 MCQs are based on first session, second session, third session. 3-day sessions are very important. Shailesh says A, Rahim says B, Satish says 3 years, that is A, Mansa says A, Usha says C. Rahim and Usha, please revisit your answer. Reason, the provision which is consisting of repair and return back, the goods should have been imported for repairs 3 years. Page number 1.15. So answer would be A. A is the right answer. Then question number 3. From this question, please be little attentive. Duty on pilfered goods is applicable if goods are lost post clearance from customs station. Goods are stolen post unloading, made good to the importer at the time of clearance. Goods are pilfered after the insurance surveyor examination. All of the above. Please be attentive. You have to examine the provisions very, very minutely. Examination. Every mark gets counted. Student who scores 99, student who scores 39, student who scores 49, and who scores 59. Every mark gets counted. So these MCQs, if you are little attentive, this will yield very good results in your examination. I could see one answer from Mansa. Answer is correct, Mansa. I'll wait for a couple of answers and then we will discuss. Important point. Learn how to read. Like when you answer, make a habit of questioning the question to get an answer. What if this term is not there? What is that this term is asking us to test? What is this particular term is asking us to validate? So have this sort of self-introspection while solving the problems. Let me see other answers. Virat says A, Rahim says D, Mansa says B. Let us understand. Question says, duty on pilfered goods is applicable. There is a pilferage. All of us know what is a pilferage. The question says, duty on pilfered goods is applicable. When? So here, when the pilferage takes place, I as an importer, I need not pay customs duty. But the question says, duty on pilfered goods is applicable. Means I have to pay the duty. Goods are lost post clearance. When the goods are lost, like I need not pay customs duty, right? Goods are stolen post unloading, made good to the importer at the time of clearance. So after goods are stolen after unloading, but these are made good to the importer at the time of clearance. When the surveyor gave his report, there was a shortage, but it was made good to the importer at the time of clearance. This is a right answer. Let's read other also. Goods are pilfered after the insurance survey. Now, pilferage, like after the survey is done, goods are stolen. So definitely, like no, once goods are pilfered, duty is not payable. So here answer would be point number B. All of the above is not correct. Reason we know pretty well that question A itself is erroneous. Then question number 4. Goods which have reached the Indian customs water on account of derelict, jetsam, flotsam shall be treated as if such goods have been imported into India. No duty shall be imposed on such goods because no person is identifiable for such import. Partly dutiable and partly exempted. Partly dutiable and partly exempted. None of them. So out of these 4 choices, what would be your answer? In case of your derelict, jetsam, flotsam. Good. This question, all of your answers are correct. Satish, Namrata, Shailesh, all your answers are correct. These are treated as if such goods have been imported in India. Very good. All your answers are right. Question number 5. Question number 5. Examine the provisions of pilferage and remission with respect to applicability of duty. Examine provisions of pilferage and remission with respect to applicability of duty. Point number A. Onus to prove in case of pilferage is on importer and not applicable for goods lost or destroyed. Clause number B. Remission is permissible only when the concerned ACDC is satisfied for pilfered goods. Clause number C. Onus to prove petty theft, etc. is not required in case of pilferage. However, in case of goods lost or destroyed, importer has to prove to the satisfaction of AC or DC consent. Clause D. There is no onus to establish in case of pilferage or goods lost or destroyed. I think even this question number 5 is easy provided you read carefully each of the options given. Options are self-explanatory. Most of you should be giving a right answer. Understand carefully responsibility and pilferage. And As I say, all the options are very, very self-explanatory to understand. If you can carefully read in between the lines, you'll get a clarity which is the right answer, which is the incorrect answer. I'll read the options once again. Onus to prove in case of pilferage is on importer and not applicable for goods lost or destroyed. Remission is permissible only when consent AC or DC is satisfied for pilfered goods. Onus to prove petty theft is not required in case of pilferage. However, in case of goods lost or destroyed, importer has to prove to the satisfaction of AC or DC consent. There is no onus to establish in case of pilferage or goods lost or destroyed. Namrata says B, Satish says D, Rahim says D. Which would be the right answer? Let us understand. Now, let's read point by point. Onus to prove in case of pilferage is on the importer and not applicable for goods lost or destroyed. Now, please understand. What is a pilferage? I gave an example yesterday. Say there is a Pepsi bottle. It's a 5 by 4. 5 rows, each row 4 bottles are there. So when you look at the crate, 20 bottles should be there. If one bottle is lifted, you can easily find out the spot that there is a pilferage. So in case of pilferage, I need not prove it's a petty theft and visible that when it's a pre-packed condition, one slot where the product is to be there, it's not there. So in case of a pilferage, I as an importer need not prove anything. It's apparently visible to the bare eye. So this option is incorrect. Second option, remission is permissible only when consent AC or DC is satisfied for pilfered goods. Please keep in mind, remission is only for section 23, not for section 13. Section 13 is your pilferage. Remission comes when there is a loss or damage. The moment they say remission and they end up with pilferage, this is also incorrect. Clause C. Though little lengthy, this gives a meaningful answer for us to understand. Onus to prove petty theft, etc. is not required. Petty theft. When I say petty theft, like if you see, see a medicine strip, say paracetamol, when you have 10 paracetamol tablets in a strip, assuming an employee takes one particular medicine. So when you inspect this particular strip, you will see that one slot, there is an empty. Now that's called as a petty theft, where apparently there is a visibility and it is not required to be proven. However, in case of goods lost or destroyed, importer has to give proof to the satisfaction of AC or DC consent. In case of remission, I give an example. What is that example? There was a fire accident. Now, how did the fire accident happen? I have to prove that, sir, I have no play in this particular incident. By some natural calamity or some reason, there was a fire incident and this particular goods have been burned or car. When the car is being lifted, the crane, there was a malfunction, it fell down and there was a damage. So here, I have to prove to the ACTC that, look, I am no party to this particular damage. So this C seems to be a right answer. There is nothing wrong. I would say C is the right answer. Let's read D also. There is no onus to establish in case of pilferage or goods lost or destroyed. This is completely incorrect. In case of pilferage, there is no onus. But in case of lost or destroyed, there is a responsibility. So answer would be clause C. Clause C. We'll come to the last question for the day. Question number 6. Explanation provided in any exemption notification shall be inserted within 2 years. Shall be inserted within 2 years of such notification, issued within 1 year of such notification, to be effective from the date of such explanation, issued within 1 year of such notification, to be effective from the date of such exemption notification. Be vigilant, be attentive, read carefully, and give your answer. Satish and Mansa, your right answer is correct, ma. Fifth question, C is the right answer. Sixth question, last question. Don't be in a hurry. Read carefully. Understand the exemption provision. I have also given one example by virtue of section 25 and give you an answer. And by the way, this particular question is also squarely applicable to our GST provisions. So don't be in a hurry. Read carefully and answer. Mansa says A, Namrata says C. Okay. I'll wait for one more answer and then we will discuss. I'll wait for one more answer. Mansa, read once again, ma. Don't be in a hurry. Read once again. Good. Shailesh also says C. Both Namrata and Shailesh, you are right. Explanation, that is by way of a clarity, circular. Inserted within 2 years, answer is no. Within 1 year of this particular notification, the circular should have been issued. This is incorrect. Point number B. Issued within 1 year of such notification, yes, to be effective from the date of such explanation. So any clarification, they say effective from the date of such clarification or explanation. Answer would be explanation is to avoid the confusion. So this is also incorrect. Issued within 1 year of such notification, yes. And this is to be effective from the date of such exemption notification. Answer is yes. This clarification is provided to avoid or to take away the imbroglio. Accordingly, answer would be clause C. So, Mansa, hope this is clear, ma? Satish, yes, your answer is correct. So these are the MCQs which are connected with our previous session. Now let's start with our today's discussion. Let me come back to my presentation. Yeah. Today's topic, before I start with my discussion, I'll give you the background, how and why these topics are relevant, and you as a student of the professional course, how you can use this particular learning. Now, one advice I would give at this point in time, if you are very serious about your career, in addition to this professional course of CA, see if you can enroll yourself for civil services, where you can participate in the civil services post-qualification. You are getting into IRS, getting into this field of IRS, Indian Revenue Service, along with the professional background of chartered accountancy, will help you to put you into a better orbit of serving the nation in various capacities. The reason why I'm telling you is this particular professional course gives us a acute advantage of getting expertise on cost accountancy, accounting, auditing, tax provisions, and legal aspects. Now, we may not be looking at more in-depth of economic reforms or economy related aspects. Once you get into this civil services and get into IRS and you join this Ministry of Finance, where you get to act upon in the policy decision making wing. And today's entire my discussion for the next 2.5 hours is going on this topic called various duties under customs law, where we will look at the economy. If there is a need of the hour, then there should be a revenue augmentation. Now, just because government needs revenue, we should not increase the rate of duty or rate of tax. Rather, We should be coming with innovative recommendations, where like e-way bill. Now, e-way bill for imitation jewelry. Since 2017, jewelry or silver articles, including imitation jewelry, were completely out of e-way bill related provisions. Recently, in 2022, there was a recommendation, and the government has brought in the provision, not yet enacted, where they wanted to bring e-way bill mechanism to imitation jewelry. Where you will see that without increasing any rate of tax, by bringing some report generation, more control of revenue is going to come into picture. Similarly, like when you compare your turnover as income tax, turnover as per GST. Now, most of you, when you file your tax audit reports, you would say that in the tax audit report, the turnover under GST is so much, my turnover as per financials is so much, and this is how IT return is calculated. So there is an exchange of data between two departments. You as a expert in a particular field, you're going to give a recommendations to the ministry. Under customs, what is our role? Under customs, there could be a threat to the economy. There could be a scope for improvisation, where a particular industry can be incentivized by giving some promotions or giving a free hand for expansion of business. All those aspects I'm going to take you through in today's discussion. Take it from me. Next 2 hours, you're going to thoroughly enjoy reading these particular provisions. However, as along with the provision, along with the background, we need to learn few procedural aspects from examination point of view. Overview of customs duty. Levy of customs duty we have discussed in yesterday's class is as per section 12. And rate for that particular levy, I have to refer to section 2 of Customs Tariff Act. Please remember, procedural aspects, Customs Act, rate and exemptions related aspects, Customs Tariff Act 1975. So, levy, the triggering point is examined under section 12. Once the triggering point is examined, I travel to section 2 of Customs Tariff Act to understand what is the rate applicable. Based on this particular classification, in case of imports, I'll look into first schedule. In case of exports, I'll look into second schedule. This is the overview how we examine the second schedule or first schedule in case of imports or exports. Then, relevance of HSN. This is your classification, harmonized system of nomenclature. Member of World Trade Organization has to abide with international trade policy. So India is also a member of World Trade Organization, because of which in India, 6-digit HSN is made compulsory. However, we have most of the cases 8-digit in case of your imports or exports. India adopted HSN as per the World Customs Organization, and HSN standard code is at 6-digit level. Generally, this is at 6-digit level. However, in India, in Customs Tariff Act, we have made a reference to 8-digit level. This gives more clarity compared to the 6-digit level. Schedule as below information. So, in institute material, they have condensed to what information you need to read. If you happen to read this Customs Tariff Act, Schedule number 1 or Schedule number 2, there will be a reference to tariff item. Like you will say, this is my HSN. That has got a description in column number 2. And this particular description, there's a standard unit of measurement for each of the product defined under customs law. And based on this, either there is a standard rate or there is a preferential areas rate. Standard rate is your regular basic customs duty. Preferential area, this is on the basis of a treaty with developing countries. So for a moment, Kenya is a developing country. Now, if goods are imported from Kenya for a particular commodity, and if there is a bilateral treaty between India and that particular nation, instead of standard rate, I prefer to preferential rate. So this particular schedule has got for each item what is a standard rate and what is a preferential rate. 99% generally this is preferred for filing bill of entry or shipping bill, and this are only when there is a reference to a particular treaty of between two nations. This is my reference to tariff act. Preferential rate of duty. What is the preferential rate of duty? Generally, standard rate of basic customs duty is applicable if goods are imported from areas notified by central government to be preferential area. Lower preferential rate of basic customs duty is applicable. Like example, say regular rate of duty is 18% and preferential rate of customs duty is 12%. Then I as an importer, when import the goods, what I have to do? I have to mention that this particular entry, it is from preferential area where my place of loading or origin. This will be available in my shipping in my particular bill of lading. This particular information is relevant for me to claim the preferential rate. Importer has to make a specific reference to applicability of preferential rate of duty. Goods are manufactured or produced in such preferential area. So here, the intent of the government is to have a healthy relation between two nations. When there are developing nations, the developing nations have to support each other. So to have a recognition of that, any goods coming from this particular developing country or the nation or the area which has been notified, and those goods which are manufactured or produced in that particular area, then you will get a benefit. Origin of goods should be determined in accordance with rules made thereunder. Now, I'll give an example. Say, for a moment, Mansa happens to be importer, and say Namrata happens to be exporter. And Namrata, in turn, purchases the goods from, say, Mr. Rahim. There are three parties. Say, Namrata has purchased from a particular country called Kenya. And this particular item, Namrata has procured from Mr. Rahim. Rahim hails from, say, Russia. R for R. Now here, Namrata just does a trading activity. So here, there are rules formulated where they say, just because the goods are originated from this particular preferred area, the importer is not going to enjoy the benefit. It has to be proven that the goods are originating from an area which is notified where the manufacturing or production is going to happen. So here, we ask for something called packing list and also declaration. So what happens here? When Mansa is importing the goods from Namrata, Namrata is selling the goods to Mansa. So importer will take a declaration from the exporter saying that, look, I have an advantage of preferential rate of duty. As per the rules prevailing in India, you as an exporter, you need to give a declaration saying that these goods are manufactured in this particular premises of you and those goods have been exported. Now, what is relevant here when I talk about this? What we're reading is this provision is theory. Now, to frame these rules, you as a professional are going to come into play. What happens here is most of these aspects, you as a member of a particular ministry, you would be traveling across the globe wherever there's a treaty. Whenever, say, India is entering into a treaty with a particular manufacturer, this particular embassy or this particular group of representatives, they would visit, they would examine whether Kenya has got natural resources, whether Kenya has got industry to do this particular activity. Let's take one example. say mosquito repellent mat. Mosquito repellent mat. This is one item which needs to be imported to control mosquitoes. Now, this looks like your this tortoise or jet, whatever mats you can see. If these items are imported from Kenya, the ministry representatives, they would try to examine, are there any factories, are there any industry who manufacture this particular item? Though there is a declaration given, is it a genuine declaration? Is it a bogus declaration? So there is a lot of groundwork which goes on to understand how a treaty is to be made, how this particular industry has to be supported, and whether that particular capacity is there in that particular nation to support these particular items. So here, probably on face of it, there could be an import, but subject to some rules and conditions, this preferential rate of duty is given. Now, one particular example, I have taken this particular notification 101 of 82, which is dated to 1st April 1982. Please keep in mind, even as on today, this particular notification is in existence. So this particular notification says, in excess of the powers conferred by Section 4, Subsection 3 of Customs Tariff Act, and in suppression of notification of Government of India, dated reference to this 352, dated to 1976, central government declares the countries specified in table below, to be preferential area for the purpose of said section, Mauritius, Seychelles, and Tonga. So any goods which are imported from these nations have preferential rate of duty. So here, the rules also are formulated where they say, mere declaration from, say, Namrata that she is having a factory in Mauritius is not good enough. Like, for a moment, so Namrata has got a office of 10 by 20 square feet. In 10 by 20 square feet, do you think that there is an industry which can be set up? Do you think that there is a process which can happen? All these are the aftermath instances which are examined on field by way of a field formation. So there are employees or there are ministry representatives who work on the field to give a particular benefit at an industry level. Now, when we read this particular notification, we feel that, sir, there was one understanding, two countries have got into discussion and we say any goods imported from these nations are exempted. Not exempted, rather, there's a preferential treatment. How to examine, how to understand that really there is a manufacturing activity happening. So all this is a instance which are lined up back to back to get into this particular policy formulation. This is one example with respect to preferential rate of duty. Before I go further, let me see if any doubts are there so far. Marxa has made a reference to Section 15, date of determining rate of duty under Section 12, Section 15, levy of customs duty. Yes, ma'am. I read Section, okay. Yeah, when we talk about that Ram Parivar, Section 15 is an instant where I confirm levy, I examine what duty needs to be paid, reference to Section 15. Yes, ma'am, your point is valid. Now, next 10 minutes, these are the provisions which were there prior to GST. However, these provisions are in existence as on today. Considering the central excise provisions, the sales tax or VAT provisions still in existence. Levy of additional duty under Section 3. Please remember, when we spoke about this levy, and also assessment, levy of customs duty plus tax plus cess plus any other cess under any other law for time being. So this additional duty, as the name says, additional. In addition to your basic customs duty, there is an additional duty under Section 3. What does it say? Any goods imported into India liability of excise duty for time being leviable on like article if produced or manufactured in India. So this concept of additional duty was brought in to make a level playing field of excise duty. So prior to July 2017, we had this advantage of excise duty. So if say Rahim has to import some goods, and these goods are manufactured in India by say Shailesh. Now Shailesh says I would charge 18% excise duty. And Rahim, when he's exporting, there's no manufacturing excise in that particular country of origin. What happens? There is a price disparity. To remove that particular disparity, additional duty to compensate the excise duty was borrowed into customs law. So here, to enable customs authorities to levy this particular duty, my additional duty under Section 3 was brought in. The duty imposed to compensate such excise duty is called additional duty, which I pay extra, called additional duty. Sorry, I skipped to the other slide. Just give me a minute. Yeah, additional duty. Then additional duty to take the role of rate or mechanism adopted similar to central excise. So Section 3, whatever I talk about additional duty, whatever central excise duty is there prevalent, the same is copied into Section 3. Post GST, excise duty is restricted to few articles, that is petrol, petroleum products, and tobacco products. So where can we refer to these particular products? Take example of grease. Grease is a product made of petroleum. Goods. Now, grease, all of you know, when there is a repair activity done on a particular motor vehicle, clutch, brakes, or in the nuts and bolts, there is a small lubricating element is applied, which is called grease. Now, this grease manufacture is subjected to GST. However, the raw material, that is petrol, is subjected to central excise plus state excise. Not state excise, I would say VAT. So, not even VAT, they call actually sales tax. They call sales tax. So, this particular central levy, state levy, because there is a levy of these goods, any grease which is imported into India, in case if the grease is manufactured in India, this would be subjected to central excise on the raw material. So, to compensate this particular price imbalance, this additional duty under Section 3 is imposed. Additional duty in case of alcoholic liquor. Yesterday, there was one interesting provision, which is Section 24, where I spoke about mutilation or denature. Denature. Now, most of us know, let's take example of this opium or incense too. This agarbatti. Agarbatti or this perfume, what we use, this consists of some element of alcohol. And this particular alcohol is subjected to state excise and also central excise. State excise alone. Because this is subject to state excise, again, this additional duty takes care of both state levy and also union levy. This is how additional duty which takes care of state excise. Central government may notify additional duty having a reference to state excise duty. In case if alcoholic liquor is not manufactured in a particular state, similar excise duty will be leviable, whichever is available in time for time being in force in other states. So as of now, to understand under Section 3, additional duty to compensate by excise duty levied by central government or state government. This is additional to the customs duty. This is by 1 point. Then countervailing duty, Section 3, subsection 3, for making level playing field to local manufacturer. Now, this is a sunset clause. All these provisions were prevalent till 30th June 2017. What I explained earlier was in relation to continuing aftermath of central excise and state excise. Prior to GST, there is a reference called Special Additional Duty. We call this as SAD. Section 3, subsection 3, we refer to this countervailing duty as Special Additional Duty. This Special Additional Duty, like additional duty, which is special in nature. In addition to this basic customs duty, specially there is an additional duty. That's why I call it Special Additional Duty. On those goods which are additional duty under 3.1 leviable or not. Whether or not I levy under 3.1, 3.3 is coming to counterbalance. Coming to counterbalance. Counterbalance what? To counterbalance the excise duty leviable on raw material, components and ingredients which are same nature of those contained in the goods imported. So here, if there is a levy not triggering additional duty under 3 subsection 1, to counter this 3 subsection 1, 3 subsection 3 comes into play to balance the excise duty applicable locally. To make a level playing for domestic manufacturers. Relevance of manufacturers of petroleum products as on date. Now, all this was relevant up to 30th June 2017. Next. Students, another 5 to 10 minutes. These are all sunset provisions. We'll just have a recap and we'll come to the important provisions which are available as on today. Special additional duty under 3.5. Now 3.3 we saw for central excise. Similarly, when 3.1 is a failure, to compensate your VAT, SAD, special additional duty was imposed under 3.5 for the purpose of compensating your sales tax or value added tax. Suppose if there is a goods which are traded. Earlier, we used to have either VAT or CST. To compensate this particular VAT or CST, the regular rate of SAD is 4%. Earlier under central excise and VAT era, any manufacturer or any trader, precisely trader, this VAT was allowed as a refund. This was allowed as a refund to the importer on sale of those goods in India. Now, because GST has been triggered, this is also a sunset provision as on today. Next. Now, from here, these are relevant provisions where one question problem, computation for 4 marks, examine the relevant duties applicable and how such duty shall be calculated under section 3 will be examined. So, to start with, first provision, IGST. IGST, because any goods imported into India, any goods exported out of India, section 9 comes into play, where it will be called as an interstate supply. In case of your interstate supply, IGST is to be applied. So, in case of IGST, section 3, subsection 7 of Customs Staff CTE is relevant. This says that in addition to basic customs duty, import of goods is also leviable to IGST. Rate of IGST not to exceed 40% and as applicable under section 5 of IGST Act. So what we will do, for the purpose of Customs Act, I refer to notification 1 of 2017 read with 2 of 2017 for rate of tax. This is in relation to taxable. This is in relation to exempt. So here, I don't know how many of you have seen a particular bill of entry. When you see the bill of entry, in that bill of entry, for the purpose of IGST computation, they refer as per notification 01 of 2017. There is a reference always made to this IGST for payment of IGST under section 3, subsection 7. Reference to notification 1 and 2. These are the relevant aspects. So here, when you look at your schedule 2, basic customs duty plus IGST. All this put together is my duty under section 12. Basic customs duty, IGST will be calculated. So here, why I am paying this? If this IGST is not there, then there is no level playing field for domestic trader or manufacturer. So to compensate this GST which is available as on today, along with basic customs fee, IGST also is applicable. This is what we need to understand. Examination, 1 mark MCQ from this particular provision. Under Section 3, Subsection 7 of IGST Act, maximum permissible IGST, they will give 4 options. What are those? First option, 18%. Second option, 12%. Third option, 28%. Fourth option, 40%. Most of us will say maximum is 28%. So this is the right answer. But please keep in mind, when you read Section 5, there is a clear reference. The rate prescribed under this particular act cannot exceed 40%. So always there is a reference to maximum ceiling of 40%. Examination out of common sense. I would say common sense. Why? We don't have a time to read. We will apply common sense and say most of the GST, if you see, highest rate is 28%. And we choose 28% as the right answer. But under Section 3, Subsection 7, the permissible maximum rate of IGST is 40%. Then, manner of levying IGST. So how do I calculate this IGST? Like example, we have under GST law. Under GST law, how do we calculate GST? Say, I'll just insert one blank slide. Just give me a minute. For the purpose of GST law, assuming that there is a supply value of rupees, say, 1,25,000. There is a discount 10%. There is incidental free supply, or else incidental cost, say 20,000. GST at the rate of 12%. Let's say IGST. So what we will do? First we will ascertain what is my assessable value or value of supply. This is as per under Section 15. For assessable value, what I will do? My value of supply is equal to 1,25,000. That is the value of supply plus incidental cost 20,000. On this 1,45,000, there is a discount of 10%. That is 14,500. The balancing figure, what we are going to derive on this, we will apply GST at the rate of 12%, right? So similarly, under customs law, I have explained that Section 3, Subsection 7 is to calculate IGST. So assuming that if the value of imports is rupees, say 2 lakh, basic customs duty is at the rate of, say, 12%. And IGST applicable is at the rate of, say, 18%. Now the question comes here, should I calculate this IGST option 1 on 2 lakh or option 2 lakh plus basic customs duty on this apply at the rate of 18%. This is a mechanism which is prescribed. How do we calculate IGST. So what all form part of as a good value per section 3, subsection 7. That we are trying to understand. Manner of levying IGST, the aggregate value of imported goods as determined under section 14. So this is examine section 12, levy, then valuation. Next class, I'm going to deal with valuation. They say, please find out what is the value under section 14. Then, or tariff value of such article fixed under section 40 and duty of customs chargeable. So they say that either go as per section 14 or go as per section 42, 14 subsection 2 for examining what is a tariff value. Now, what is the difference between these two? Wait for the next class. I'll explain how value is derived under 14 or 14 subsection 2. Either of these two, and that is adding duty of customs chargeable under section 12. Above mechanism squarely gets applied for compensation cess. So what I will do in the previous example, I would take 2 lakhs plus basic customs duty. Whatever value I'm going to derive on this, I'm going to charge my GST of 18%. This is prescribed under section 3, subsection 8. Section 3, subsection 8. This is how I calculate. End of today's class, one particular problem. I'll take you through to understand how this particular IGST or compensation cess is computed. Now, I referred to section 14, subsection 2. This is an example for section 14, subsection 2, where there are some items where instead of the commercial value, the government is going to fix upon per reference to a particular parameter how the duty has to be measured. So here they say per metric ton, the tariff value US dollar per metric ton. So per metric ton, they say 989 US dollars. This into exchange rate, I'm going to get my transaction value. On this particular item, I would calculate basic customs duty. So here 14 subsection 2, instead of your commercial value, government has a authority to prescribe the predetermined rate. Like you can see crude oil, palm oil, formalin, soya bean oil, brass, scrap. So there are a few items where always there is a susceptibility, there is a facility of accommodating price, not to interfere, and these prices are fluctuating on a regular basis, like your gold and jewelry, your jewelry rate which gets fluctuated. These oil rates also keep on fluctuating based on the trade which takes place at abroad. And this is one particular area where a lot of analysis, people like you and me, post-qualification will be working upon to say, what is the barrel rate? And this barrel rate denominated in a foreign currency, we will try to examine based on the stocks, based on the demand, based on the competitive price, based on the industry practice. We try to fix upon a particular rate for a particular period of 30 to 45 days. So every month there will be a notification. In that particular notification, they'll say, for this particular period to this particular period, please adopt this particular tariff rate. So this is one area where you would be interested to examine how the industry is going to perform. So generally what we do, when we do a statutory audit, when we do internal audit, we just say that there's a related party transaction. In your notes to accounts, you will say, there are foreign remittances, 15 CA, 15 CB is issued, and this is my value of inventory valuation A is 2. This is how I derive my cost. Now, in addition to that, if you try to examine my commercial value, assuming it is 10,000 per barrel, my customs duty, they are demanding on say 9,800 per barrel or probably 12,000 per barrel. Now, I cannot challenge, though I'm paying 10,000 to my vendor, why is that customs authorities are asking me to pay 12,000 per barrel? This is a policy matter which government is going to decide. Now, who is going to fix? Who is going to play around? This is $1 million question. Once you get into this ministry, you would enjoy the luxury of knowing this information. Moving further, Section 3, subsection 9, compensation cess. This compensation cess is similar to our IGST. Like we have the sin goods. What are those sin goods? Soft drinks, tobacco products, motor vehicle. So any of these high value items or sin goods, we pay compensation cess. What is a compensation cess? In order to take away the burden, in order to take away the loss of revenue to the respective states, there's a levy of compensation cess under Section 8 of GST Compensation Cess Act. So this compensation cess also is applicable in case if it is applicable in India. Like as on today, let's take example of motor vehicle. So if I buy a Maruti car which is having a price more than 10 lakhs, 28% would be the GST, 12% will be the compensation cess. 28 plus 12, 40% is going to be my tax. So the way IGST is computed, similarly cess is also computed. And value in case of warehouse goods. Now, before I start with this provision, let me see if any doubts are there further. IGST 18%. Oh, okay. Arun James gave an answer of IGST 18%, probably referring to that 40% rate example. Social welfare surcharge 10%. The social welfare surcharge, Arun, let's wait for another 15 minutes. I'll explain this social welfare surcharge. No questions so far. Students, hope you are understanding the provisions now. Value in case of warehouse goods. Now, I'll give you the background of warehouse, which is quite interesting for us to understand. Let me take a blank screen. Okay. The concept of warehouse. This is one interesting and innovative concept. How business can be done, how working capital can be managed. This is one wonderful concept. I'll give an example. Say there is a company called Kirloskar Motors. K Motors. This particular company has got various commercial vertical lines. One of that particular commercial line is manufacture of DG set. Manufacture of DG set. Now, this particular manufacture of DG set, assuming the rate of tax, say the GST is at the rate of 18%. The DG set is having a GST at the rate of 18%. And the basic customs duty, say it is applicable at the rate of 12%. Okay. Now, assuming for a moment, there is a customer called ABC INC. This particular customer is in Singapore. I call the customer has got one more customer. I'll call third party customer. Third party customer who is in, say, USA. This particular third party customer is in USA. Now, this particular Kirloskar Motors supplies the goods to this particular customer. This customer does a manufacturing activity and supplies the goods to this particular customer in USA. Now, the manufacturing cost, that is the process cost, is assuming 18% if it is done in Singapore. The same if the process is carried out in India. In India, the process cost is assuming 10%. I'm just giving a hypothetical example. The process cost is 10% in India. It is going to be 18% in, say, Singapore. Now, this particular customer who is there in Singapore, this particular customer will say to this particular Kirloskar Motors, do one thing. I'll give you three components. What is that? So one is engine, second is alternator, third is acoustic. Now, this is how the industry happens, ma. I'm giving a very, very practical example how industry operates. Now, these three parts have to be assembled to manufacture something called DG set. Now, when you look at these components, my rate of tax for engine is 28%. My rate of tax for alternator is 18%. My rate of tax for acoustic is again 18%. This is the composition of my rate. So here, say there is another manufacturer in India, say Shakti Motors. Now, this particular customer, ABC Incorporated, what he will do? He will supply item number 2, item number 3 to K Motors, who is there in Maharashtra. I'm explaining this example. Please follow carefully. ABC Inc. has supplied this alternator, supplied this acoustic to this K Motors, who is there in Maharashtra. And in turn, this particular ABC Inc. is going to buy this engine from Shakti Motors. Now, Shakti Motors, for a moment, is in Tamil Nadu. This Shakti Motors will ship to the warehouse of this Kirloskar Motors, and he will bill to this particular customer in ABC Inc. Now, the goods, this alternator and acoustic, when it is imported, instead of bringing to factory, option 1, I have two options. Option 1, bring to factory for assembly. Option 2, take to warehouse. Now, this is your customs bonded warehouse. So what am I doing here? I'm bringing the goods to the bonded warehouse. I'm doing this particular assembly. After this assembly, I export. So when I do this particular activity, this particular entity called K Motors need not pay basic customs duty, need not pay IGST applicable on these aspects, and if paid, refund of this particular taxes or duties need not be applied. What am I doing? I'm saving entire money. Now, please understand, there are few aspects, like I can do basic manufacturing activity. I can do basic warehousing activity in a warehouse. So these are all permissible activities in a warehouse. Now, what am I doing? My factory in Maharashtra is a very small space. I will ask this particular customer called ABC Inc. Please send your items to India. I'll take it to warehouse. I'll assemble. I'll take these motors from India. I'll assemble together and I'll send these goods out of India. So here, any process undertaken in warehouse, which could be a small process or which could be a manufacturing activity, is permissible for the purpose of GST law. So the goods which are used in warehouse, what am I doing? I'm trying to save customs duty. I'm trying to defer my outflow of cash. I'm also saving my factory space. I'm also minimizing my business space. I'm getting big orders with a couple of legal provisions here and there. So this is one activity which we can do using warehouse under customs law. This is little high fund business model which is done in a warehouse. I'll pause here for a minute to see if there are any questions so far. Students, I'm giving these examples in a minute way to the best possible to make you understand how post-qualification we can make an advantage of these customs provisions and also the road less travel. These are the areas where not many professional chartered accountants or cost accountants are into practice. You, once you get qualified, if you decide to have a specialization, I would say welcome to this industry. This is one of the fantastic area where you have a promising career. Now, warehouse concepts, are we clear so far, ma'am? I don't see any doubts, so I'll continue further. Now, I'll come back to this warehousing, valuation in the warehouse. In case of a warehouse goods under section 8 subsection 8A, goods deposited into bond or warehouse, such goods are sold before clearance for home consumption. Value for IGST shall be higher of value as per section 8 or transaction value. So here, there is something called into bond. Into bond. That means to say, I import the goods. These goods imported are placed in warehouse. Some process is undertaken. Then these goods may be exported or these goods may be cleared to domestic tariff area. So here, for the purpose of this section 3, subsection 8A, they say that value as per section 8, which is your normal transaction value, which is reference to into bond, where they will say the value of into bond, the value of your customs duty. These two aspects derived under section 8 or transaction value, whichever is higher. So I could have into bond and this value or transaction value because of this process activity, transaction value which is much higher. So when I imported at the time where I filed this into bond, what is the basic value? That is import price plus basic customs duty. This together is called my into bond value, which is under section 8. In case if there is a valuation which is happening, then I would call that as a transaction value. Higher of these two is referred for my basic customs duty purpose. Then, warehouse goods are sold more than once before such clearance for home consumption. Transaction value of last transaction shall be the transaction value under section 3 subsection 7. Like example, say importer. Rahim happens to be importer. What Rahim has done? He brought these items into bonded warehouse and he was trying to examine how the market is going to be. And based on the market movement, Rahim sold the goods to Mr. Arun. Arun sold the goods to, say, Mansa. Mansa sold these goods to, say, Shailesh. Finally, Shailesh has sold these goods to Namrata. This is called exchange of title to the goods. Also may be called as IC sales. Prior to goods coming to territorial water, IC sale. Once the goods have come into territorial waters, exchange of title, there's a transfer. So Rahim sold to a trader called Arun. Arun sold to Mansa. Mansa sold to Shailesh. Shailesh sold to Namrata. So here they say, warehouse goods are sold more than once before such clearance for home consumption. Then transaction value of last transaction. What is the price collected by Mr. Shailesh will be the transaction value. Concept of bill trading for warehouse goods, not a punishable activity. Now please keep in mind, this is the learning what we have. Most of the concepts, most of the business we don't know. Now, the advantage of reading this particular provisions are not from examination point of view. Exams तो आएगा जाएगा, जुगाड़ करके पास हो जाएंगे. But how do we make a career out of this learning? How do we master? How do we excel? How do we call ourselves as a professional from this particular subject? Read with an intent of learning and making a career out of this particular subject. So here, I can do a trading activity, keeping the material in warehouse. Most of this, what do you call perfume? I don't know how many of you have done the audit of this perfume industry. This chemical composition which is used in this agarbatti manufacturing or your body lotion, etc. These perfumes are traded by some set of people where if you say their turnover in the balance sheet, crores of rupees of turnover is there. And if you say their physical premises, it would be hardly 1000 to 1500 square feet, where at best they have 10 barrels, 10 small containers. It's not the container which brings the business. It is a mixture of each composition where chemicals are mixed at a particular level to bring a definitive incentive stick. One case study in the previous online classes, I gave example of this one company called Three Roses, not Three Roses. What is that? 3-in-1 agarbatti. I don't know how many of you have read this case law of 3-in-1 agarbatti. When you light this 3-in-1 agarbatti, as the name says, 3-in-1, there are three chemicals which are put into one agarbatti. Like example, say jasmine, rose, and say sandalwood. So when you light this particular agarbatti, you have either sandalwood smell or you have jasmine or rose. But they have a the formula where 1/3 you'll get rose smell, 1/3 you'll get jasmine, another 1/3 you get sandalwood. Now this is the reason they name their brand as 3-in-1. You have to differentiate yourself in the market. If everyone is selling sandalwood, यार sandalwood ना मेरे को बोर लग गया, but I want something new. That is how this invention of 3-in-1 came into picture. And mind you, this is one company who have patent rights for this particular composition. No one can imitate or make this similar product. So innovation drives your business. How to be competitive, how to be excellent, how to be more into the business. You learn by these tricks which are in existence. Coming back, reference to entry number 8 of Schedule 3, which talks about your this IC sale relevant for my valuation of warehouse goods. Students, we are at 7:33. Let's have a break for 10 minutes. We will resume back at 7:43. start with our discussion. So far, so good, no doubts. I'll travel further. Section 6 and 7 of Customs Tariff Act have a reference made to protective duty. Now, there is a reference of Tariff Commission established under Tariff Commission Act. Tariff Commission is a composition of a group of people where they examine the industry, they examine the product, and wherever they feel that there is a loss of revenue which is happening, then there is a recommendation made by this particular Tariff Commission to augment revenue. For the purpose of revenue, they say that, look, this is one particular industry where we are collecting customs duty at a particular rate. However, if this rate increased to so-and-so particular rate, they would be beneficial. Or there is something called protective duty. Purpose of this protective duty is to control the glut of cheap imported articles into the market. So here, government thinks that there is a continuous dumping. The products are coming into India which are very cheap in nature. So to protect that particular activity, they may levy something called protective duty. Section 7, these are the provisions where recommendations made by a tariff commission, to increase my revenue, I may levy a duty called revenue duty. To protect a particular industry, I may levy something called protective duty. Glut of cheap imported articles, to take an example. Say, let's take example of postcard. Now, New Year is around. We will see that a lot of people exchange few gift articles. Like any gift article which is manufactured in a bulk mass way and from, say, China. Generally, most of these provisions of Section 6, Section 7, Section 8, Section 9, all this anti-dumping duty, safeguard duty, countervailing duty, all these are mostly referred to products from China. So in case if there are any cheap products which are getting glutted into Indian market, to protect particular industry, they may levy something called protective duty. This is just a reference. Safeguard duty. Now, I have to give one example to, one particular example I've taken from this particular, Gazette notification. Safeguard duty has been levied under Section 7 on 2016. Safeguard investigation concerning imports of unwrought aluminium, not alloyed in aluminium alloys, into India. There was a commodity called unwrought aluminium. Application was filed by Vedanta Bharat Aluminium Hindalco, saying that there was an application filed by these three companies saying that levy of this safeguard duty is not relevant because the rates prevalent in India are at par with this particular price which is being imported. So just for reference purpose, there is nothing to do with your examination. So a person who is affected with this particular safeguard duty, they may file an application to this particular tariff commission to examine. So you made a reference to so-and-so commodity and so much of safeguard duty you have proposed to levy. However, if you see the local domestic manufacturing activity, this is a rate prevalent. And as per this, you can take back your recommendation for safeguard duty. And this particular protective duty has to prevail as per the date indicated for its insertion in Schedule number 1. Schedule 1 refers to imports. So all goods which are imported based on the notification, the day this notification has come into picture, from that day, this safeguard duty or protective duty is relevant. Alteration of protective duty to be afforded by reference to article manufactured. So here they always specify on what articles this protective duty is imported. Increase in the duty rate, approval from Parliament is required. So any protective duty which is imposed and they want to alter, they want to improve this particular duty rate, then approval from Parliament is required. Till receiving the assent from Parliament, any act done as per the notification, it shall not be void. It shall not be void. But the reason, now there is something called winter season, summer season. So Parliament may not be functioning round the clock 365 days. There are only specified days where Parliament functions. At times, the Parliament may be formed for 10 days point in time. And within 10 days, there could be some bills which are of important, which may get approved, may not be approved. Just because Parliament has not approved any particular notification, no one has a right to challenge saying that it shall not be void, it shall not be valid. So here, customs authorities have enough powers to levy something called protective duty. However, their duty to put it back to the Parliament to get an approval from both the houses. Then, under Section 8, there's a power vested to the central government to impose or enhance export duty. Now, this power is like emergency nature, emergency power. What is this emergency power? To impose or to enhance, to levy or to enhance export duty. Central government may impose or enhance export duty by making amendment to second schedule. Please remember, schedule number 1 is for imports. Schedule number 2 is for exports. Examination, when you write your answers, you may not refer to Section 8. However, if you say central government has the power to enhance the export duty by making reference to second schedule, this gives the impression to the examiner saying that student has a basic understanding of Schedule 1 or Schedule 2. That gives a more mileage in terms of presenting your answer. Again, no hard and fast rule. Moving further, this enhancement can be done by way of issuance of a notification in official gazette. Goods may or may not be specified in second schedule. So if the goods are not specified, even then the central government has got a power under Section 8 to include certain items. For example, milk. During summer, there is a shortage of milk production. Common phenomenon. Summer, you will have extreme heat, water scarcity, this crop yield may not be there. Whatever this cattle feed is required, at times there could be a shortfall in the cattle feed. Now, in summer, especially to protect the industry, they may say any milk which is being exported out of India, they may enhance the export duty, or they make it so costlier that the product itself is not exported. For a moment, the milk which is being exported, the regular duty is at the rate of rupees 60 per liter. Using this power of Section 8, this 60 may be made as 120. Why? To make it more costlier to protect the domestic industry. One another example, COVID point in time. The face mask what we have, because of shortage, government has banned for few days the export. Later, this was put at a premium price. This 5 rupees or 10 rupees mask what we buy as on today, most of you would agree with me that would have paid 100 to 200 rupees to get that mask. So that's how government can exercise its power to enhance or impose any duty. Similar to 8A talks about import duty, Schedule 1. So reference to first schedule, government by way of a notification can either impose or enhance duty on goods which are there in the schedule or which are not there in the schedule. Next, moving further, Section 8B. Now, from here, the interesting chapter starts. We will again start understanding the policy making decisions connected with levy of various customs. Section 8B, examination. Please make a note. Section 8B, Section 9, Section 9A, Section 9AA. Please write down. I'll write here. Section 8B, then Section 9, then Section 9A, Section 9AA. These four provisions, for sure, one question will be tested for 4 marks. This is the scope of your this chapter. Reason? Quite, I would say, cross-jumping or confusion will be there when you make an attempt to solve or write your answer. But these are the four provisions. Entire this chapter revolves, and also interesting provisions connected with our today's discussion for next 40 to 45 minutes. These four sections we would understand. Coming back, Section 8B. Existence of circumstances for imposing safeguard measure as below. Articles imported in increased quantity. Articles imposed in increased quantity. Section 7 talks about protective duty. And this protective duty is in relation to cheap goods glutted into India. Cheap goods glutted into India. Now, those goods may be used, may not be used, but for various reasons. There is a glut of all these cheap goods coming into India. Then protective duty comes into picture. In case of 8B, this is not a cheap goods. Goods are getting dumped into India. Articles are imported in increased quantity, and such increased quantity, such increased importation is causing threat, to cause serious injury to the domestic industry. Let's take a very simple example. Example of, say, umbrella. There is a natural disaster which is going to come into place. Umbrella is being imported. Umbrella, probably this is an example for Section 7. Umbrella, I can refer to Section 7. For Section 8B, let me take example of laptop. Laptop is not a cheap commodity. Laptops are being dumped or being imported. Laptops are imported in bulk quantity. Now, various reasons. As a industry, as a ministry, we don't know the reason, but please take it from me. The government officials are watching what is coming into India, what is going out of India. If they feel that over a point in time, some goods are getting imported in bulk quantity, and that particular import is going to cause an injury to the domestic business, then 8B is going to be invoked. What does 8B say? They levy something called safeguard duty. Basic customs duty plus safeguard duty. In addition to this, regular IGST and cess is levied. So here, on the basis of a pattern, now when I say pattern, there is a reference to index. When I say there is a reference to index, there is a statistics. There is a history. The government officers, the customs authorities are going to watch what happened in last 2 months, what is happening in the current month. Based on this, they take the statistics. They try to analyze in a meaningful manner, which is called as your data mining. And please keep in mind, students, I had given a reference to civil services. Also, if you can have some value add on data science. If you add to your career something called data science, that also will add a additional advantage to get into a better industry. And that indicates that there is a increased pattern of imports to India. Then the central government may exercise power under AP to levy something called safeguard duty. To give an example, there was a reference to one particular exemption notification where reference to tariff 187,304, which talks about seamless tubes, pipes, and hollow profile of iron, alloy, or non-alloy steel cast. The country of origin, the goods which are coming from China, country of export, again China, producer. They have given the name of the manufacturer also, and specification. They have given various specifications, and the amount per metric ton. The safeguard duty imposed is 1,194.60, probably dollars. This is in dollars. So the government has got a ready-made information of a particular commodity and also from which country this particular goods are coming, and also from there which manufacturer or which producer. They tabulate saying that from this country, in this particular place, in this region, this particular manufacturer, any goods coming from this particular manufacturer, and below is a list of pattern. Each commodity, this is going to be safeguard duty. The difference between section 7 and this 8B is that is cheap products. This is other than cheap products. This is my safeguard duty. The central government has a power to exercise this provision for virtue of safeguard measures. What they can do? Imposition of safeguard duty or application of tariff quota. Now, this is a interesting and beautiful part of this particular provision. They say there is a reference to something called tariff fixing committee. Group of people are identified to fall something called tariff committee, tariff reference committee. I call TRC. This tariff reference committee, their job is to fix something called tariff quota. Tariff quota is an indication of percentage or quantum. Now, this entire provision is interlinked with your data analytics, where they say to impose safeguard duty, or instead of levying safeguard duty, I apply something called tariff quota. The tariff quota is the percentage of imports allowed from a particular manufacturer or from a particular country. Other measures the central government deems appropriate. Central government may allocate tariff rate quota to supplying countries. Safeguard duty is in addition to any other duty specified. So what they say, like we let's take example of Czech Republic of China, Indonesia. I'll say Indonesia, then Burma. Also, let's take example of may not be relevant. Okay, let's take these three countries all together. China may make a direct supply or may make an indirect supply. Burma may make a direct supply. So here, the central government may decide all put together what should be the percentage of imports or country specific. I fix something called tariff rate quota. I fix something called tariff rate quota. Average level of tariff quota. This analysis is done on the basis of last 3 years. And this safeguard measures, there is a validity of 4 years. Once a notification is issued to fix a tariff quota, that particular notification is valid for 4 years. And if the government feels that this particular committee recommendations are relevant, maximum up to 10 years, this committee recommendations can be taken forward. So this particular exemption, this particular safeguard measure says that articles from developing countries, so long as the share of imports of that articles from that country does not exceed 3% of total imports. So here they are saying that, look, I'm going to import something called safeguard measure. And to get away from this safeguard measure, I will give a relaxation to developing countries. So where do I find developing countries? I gave an example where Singapore, Mauritius is there. So there are nations, there are countries which are identified for this particular purpose. They say individually from that particular country, out of total imports, that exports from that country should be maximum 3%. Articles originating from more than one developing country, so long as aggregate in totality of imports each individually should be less than 3% and in aggregate should not exceed 9%. So they're saying that individually each particular nation maximum 3%. In aggregate, it should be up to 9%. In case if it is exceeding, then section 8B can be safeguard measure. Safeguard duty can be imposed. Examination, one question can be asked. How? Say, particular steel supports are imported from Kenya. Kenya is designated as an important nation. And there is a sudden inflow of goods into India, and imports from Kenya constitute 5% of total imports. 5% of total imports. The applicable safeguard duty is at the rate of 30%. Examine provisions of section 8B whether this imports from Kenya are subjected to safeguard duty. Then what you will say, you'll explain the provisions of 8B when the safeguard measures are applicable. When these safeguard measures are applicable, reference to tariff rate quota, reference to developing countries, and per nation the ceiling available. Here, the maximum ceiling is permissible 3%. Because in the given example, it is 5%, you will conclude that because the imports from Kenya exceeded the permissible tariff rate quota of 3%, safeguard duty at the rate of 30% is applicable. Concluding that, you will also calculate the applicable customs duty. So how do you calculate? Basic customs duty plus safeguard duty plus IGST. This is how you will calculate. In between, you have something called social welfare surcharge. Social welfare cess, which I'll explain maybe another 15 minutes, 25 minutes from now. Next, subsidized articles. Before I start with subsidized articles, let me see any doubts so far. Mansa says protective duties ensure healthy competition. Not exactly healthy competition, Mansa. It's not even competition per se. Protective duty is to protect the industry. Why to protect the industry? They have cluttered the market. You are not allowing the need to manufacture. Also, the commodities have come where there is no necessity. Like example, it's as good as electronic waste. Now, a particular nation wanted to protect carbon credits. To protect their carbon credits, some of the scrap has been brought into India, not directly as a scrap, maybe as a cheap products. What do you mean by cheap products? The scrap which is generated has been melted and it is made as a cheap products like keychain, umbrella, pen or comb. All these are cheap products where there is a glut of that scrap coming into India. To protect the nation, they have levied this protective duty. Where I levy, like the commodity might be pricing 20 rupees. The duty may be around 200 to 250 rupees. Now, why 200 to 250? Not to dump that scrap into India. They make a analysis and they bring in protective duty. So, not exactly for competition purpose. Then next point, Mansa says, We have GST council. Is there any council in customs law? There is no council in customs law. Rather, there are various committees and various wings which work for these recommendations. And take it from me, if you get into this Ministry of Finance, not everyone have a clarity where they want to be and where they can be at a point in time. Out of my experience, I'm making a recommendation. I'm giving a suggestion. If you can aspire to be a civil servant, get into IRS with this professional background of CA and little bit of your technical knowledge on data analytics, sky is the limit. Sky is the limit. You can make recommendations, you can do analysis, you can give suggestions how to augment revenue. So this is my suggestion for most of you. Coming back, section 9, subsidized articles. Subsidized articles where there is again, this is a customs duty, addition to customs duty. There is a countervailing duty. There is a countervailing duty. Any country, territory, directly or indirectly, pays or bestows subsidy upon the manufacture or production or exportation of any article. Manufacture, production, exportation of any article. Subsidy to include transportation. They also say subsidy might be in relation to transportation also. And such articles are imported into India. These articles are imported into India. The article may be in same condition or as when exported from the country or manufacturer production or may be changed in condition by manufacturer production or otherwise. So here the background is, let me see if I have taken, I have taken one example. In relation to countervailing duty, this is one slide where there is a tariff item of 7411. This 7411 refers to copper tubes and pipes. And these copper tubes and copper pipes are originating from Malaysia. Country of export, any country including Malaysia. Any country including Malaysia. Now, this is one example where direct, indirect. Direct route, indirect route. Where China may send the goods directly to India or through Malaysia, the goods from China travel to Malaysia where there is an unpacking, there is a change in the label of manufacturing, and from Malaysia, this comes back to India. And also, they have given a reference of a producer, the manufacturer, Metuben STN, any producer other than producer mentioned above. And the rate of customs duty, that is your countervailing duty, is 5.31% of CAF value. Now, please understand, this one slide, what I'm showing to you, is by virtue of a notification. How is it possible? How is it possible to levy this subsidy or to examine this particular subsidy? Now, the background for us to understand for this is, first, you should be a person who have an acumen to read financial statements. Second, you should also have an expertise to understand the business process. You should also have an acumen to understand how to read a cost sheet. You should also be an acumen to understand what is the industry, activity. You should also have a knowledge to understand the end users and competitive other markets. In the sense, this one slide of countervailing duty is originating from so much of analysis where the designated committee have to analyze this commodity which is coming into India, Is there a related party transaction? So there is no related party transaction. Fine. Next question. Is this particular commodity manufactured in India? Maybe yes, maybe no. If it is manufactured in India, what is the cost in India? My cost in India is 12,000. The value of goods imported is 8,000. Right? How come it is possible? 8,000 is what you are importing. In India, it is manufactured at 8,000. The next question, they travel further. Is there any incentive received by this particular company? Please remember your accounting standard 12. Accounting standard 12 deals with accounting for government grants. Similarly, there is a reference to your INAS. When I read the financial statements, is there any incentive bestowed on this particular company, this particular manufacturer, directly or indirectly by the government? And that subsidy is helping them to reduce their export price. And especially, does the government of that particular country says only those goods manufactured and exported to India, you get a subsidy. Like example. But this is nothing wrong. I'm just giving a parallel reference. Now, when I look into MEIS, Merchandise Export from India scheme, there is a designated nation. There is a designated nation where there is an incentive of 2% to 5%. Say, any goods manufactured in India sent to UK, I get an incentive of 2%. Now, I account this is a duty drawback in my books as a subsidy, as an incentive, not a subsidy. I call this as an incentive. Now, here, my financial statements is indicating that I'm getting so much of subsidy for goods which are manufactured in India, exported to so and so nation. Now, is that a subsidy just to reduce the price for the goods which are going to that nation? Answer would be the treaty between those two nations. And the damage which is going to happen because of those goods to the Indian market. In addition, you also try to examine what is their cost share, what is their activity, how the pricing is given for those goods coming into India, those goods which are going outside India. So based on these factors, the government may formulate under Section 9 something called Countervailing Duty on Subsidized Articles. So here, these articles, important is your point number 3. These articles may be in same condition as when exported from the country or manufacturer production, or may be changed in condition by manufacture production or otherwise. Now, semi-knocked down or completely knocked down. From China, the goods have come in this fashion. It reached Malaysia. In Malaysia, there is an assembly which took place, and they say this is manufactured and the goods are traveling to India. In this route, directly or indirectly, when there is a change in composition, then the ministry may invoke provisions of Section 9 to levy something called countervailing duty to safeguard this subsidy. The catch point for all these levies, subsidy given directly or indirectly. If the subsidy is given directly or indirectly, which includes transportation also, Section 9 comes into play. And this is one example, students, I have given. I have not given a notification reference, but goods imported from Malaysia, there is a levy of this countervailing duty. Now, examination, this is one theory question which could be tested for 4 marks. What are the circumvention measures under Section 9 of Customs Law, Customs Tariff Act, for levy of countervailing duty on subsidized articles? The circumvention measures means alternative routes to hide your intent. Point number 1. By altering the description or name or composition. I altered the description, name or composition. So what I have done, CKD become SKD. SKD has become assembled product. Or ball bearing has been called as bearing. Bearing has been called as ball bearing. Now there are change in the description. By import of such article in unassembled or disassembled form, by changing the country, like I said, country, nation 1 to nation 2, nation 1 to nation 3, back to India. So I changed the country of its origin or export. Now there is something called declaration. So the exporter is giving a declaration saying that the goods are manufactured in Singapore, the goods are manufactured in Malaysia, the goods are manufactured in Bhutan. So they give that particular declaration saying that I originated from here. But in reality, the goods have been coming from elsewhere. In any other manner, whereby CVD is rendered ineffective. Some other means which are innovative time to time tested. Now here, look at the kind of homework goes in the ministry. Now we feel very, very burdened to read a notification, understand a notification. For a moment, assuming that I have been posted in a particular mining industry, particular steel industry. Assuming for a moment, I pick a student called Namrata. Namrata, she was posted into steel sector. Rahim is posted into plastic sector. Say Arun is posted into rubber industry. Now what these people will do? They read the news of that particular country. They read notifications of that particular country. They read what is the investments done in that particular country, in that particular sector. Now, so much of analysis gone to understand what notification has come from that country based on the statistics available in the public domain. They take, they analyze, and they levy a trap. Look at this notification. How much of R&D goes into identify the company which manufactured this copper tubes which are originated from Malaysia. So much of homework, so much of courage is required to say that I wanted to levy this countervailing duty where there is a subsidy involved by Malaysian government to this particular company. And keep it in mind, importer can always challenge this notification. And when this is challenged, the customs officer not going to just like that levy this. They need to have like the working papers, the backup papers to substantiate this particular levy. Moving on further, subsidies article, there's a cap on countervailing duty. Means how much is the countervailing duty I can levy? The ceiling of this is this CVD shall not exceed amount of subsidy. So in the books of accounts, the element of subsidy recognized is the maximum amount. So for this, accountant knowledge is required. So chartered accountant like you and me are very much required for the ministry to deep dive into this information. Point number one. This countervailing duty is in addition to basic customs duty. CVD is not to be levied unless it is determined that subsidy is in relation to export performance. Like one example I gave, MEIS notification. When I look at this MEIS notification under foreign trade policy, this is a public document. Now, can this particular document can be challenged in international court of law? It cannot be challenged. For a moment, from India, any goods which are traveling to UK government can formulate, I levy 2% countervailing duty for the subsidy given by Indian government. There's nothing wrong. Indian government want to incentivize for those goods which are going to UK. So in case UK government feels that there's a threat to the domestic market in UK, England, they may levy this countervailing duty called subsidy. This subsidy relates to use of domestic products over imported products. Very, very important. Now, when you read this notification, in that nation, in the example Malaysia, the government of Malaysia, when they have given subsidy, they say only those domestic manufactured goods used for copper tubes manufacturing rather than imported goods, you get a subsidy at so and so rate. In case if the goods are manufactured and exported to India. Because there is a public notification in public domain, I read that those goods domestically used where there is an incentive given, which is a subsidy, I take the balance sheet of this particular entity. So how do I get a balance sheet? Balance sheet like our ROC, there is a repository in foreign nation from where we can get these public documents. And there are various routes. How do we get these documents? You would have seen this spy movies where this information is called for. All this pattern, patriotic movies. Subsidy conferred on limited number of persons engaged in manufacture. Generally, those traders who are not those people who manufacture or produce these goods, only on them this subsidy is imposed, not otherwise. Other aspects of Section 9, levy of countervailing duty shall be invoked till dates of its revocation. Time limit is 5 years. Central government may extend this particular countervailing duty for another 5 years. Before I start with anti-dumping duty, let me see any doubts. Hope you are enjoying, ma'am. Hope you are getting the clarity on the concepts. Next, moving on further, anti-dumping duty. This anti-dumping duty, where there's a price which has been affected or which has been reduced intentionally to dump that particular product into India. I call dumping of goods with a price reduction. Please keep in mind my provisions of safeguard measure, section 8B, which deals with safeguard duty, where there is a dumping. And this provision, section 9A, deals with export price of a product imported into India is less than normal value of like article sold in the domestic market of the exporter. So here, there is a intentional dumping with price, I would say price reduction. So in case there is a dumping, when I say dumping, there is no price difference. Goods are like laptops are being dumped into India every day. The government is not able to control that dumping. Because of that dumping, the Indian manufacturers, Indian industry is going to get affected. Then section 8B comes into picture. The next aspect under 9A is anti-dumping duty. Now this is also dumping, but the difference between 8B and 9A is in 9A, with the intention of cutthroat price competition, with the intention of killing the domestic market, dumping happens. Like example, I slightly alter this dumping of laptop under section 8B to 9A. 8B, whatever may be, like just remember, whatever may be, irrespective of the price, dumping happens. In 9A, alter price, I would say, just to catch point, alter pricing. So here, assuming for a moment, let's take example of China laptop. This China laptop, if it is, it can be sold in domestic market, it can be sold to exports to India. Assuming that if I denominate this in dollars, in domestic market, it is sold for, say, $500. For export market to India, this is being sold at $420. Now, look at the price pattern. If I sell this laptop in China, I sell for $500. But the very same laptop, if it is sold to Indian market, it is sold at $420. Now, what is happening here? This is a alteration of price where there is a dumping, which is called threat to the local market. This, to protect this particular dumping, levy of anti-dumping duty under section 9A comes into picture. ADD, anti-dumping duty, can be imposed only when there is an Indian industry which produces like articles. So there is an Indian industry which also manufactures similar articles. This duty is country specific. This duty is country specific. Now, one example before we come back in detail on anti-dumping duty. This slide talks on its own. Anti-dumping duty. And whereas in the matter of review of anti-dumping duty on import of subject goods originating in or exported from subject countries, designated authority in its final finding. Who is the designated authority? Like I think Mansa asked this question, GST Council. There is authority under customs law. The designated authority could be a tariff review commission, published by notification 7/09/21 DGTR dated 30th September 22, published in the Gazette of India Extraordinary so-and-so, September 22, has come to the conclusion that there is a continued dumping of subject goods from the subject countries and the imports are likely to enter Indian market at dump prices. They are saying that subjected goods from subjected countries and imports are likely to enter Indian market at dump prices. Look at the courage you need to have to bring in a notification in the event of cessation of duty. Dumped imports from subject countries are causing injury to the domestic industry. The information on record, what is a record? I have to shows likelihood of continuation of dumping and injury in case of anti-dumping duty. Enforce is allowed to cease at this stage. There is a sufficient evidence. I have evidence to indicate that revocation of this anti-dumping duty at this stage will lead to continuation of dumping of injury to the domestic industry and has recommended continued imposition of anti-dumping duty. Look, the committee have recommended to continue anti-dumping duty on imports of subject goods originating from that exported from that country in order to remove injury to the domestic industry. Now, this is a table continued of this particular notification. What do they say? The items having tariff heading 5307, which is called as a jute yarn, which is in any form, in all forms and specifications. This jute yarn can come in any form, any specification from a country called Bangladesh. Country of export, any country including Bangladesh. So the goods may come from Bangladesh or maybe from any other country indirectly. And also they have identified a producer called Hassan Jute Mills Limited. Hassan Jute Mills Limited. And the amount of duty indicated is nil. Currency per unit, US dollars indication. So here, first case, second case, they have given nil. Probably there is a relaxation. Third case, if you see, there's a manufacturer called Alina Jute Mills. Alijan Jute Mills Limited. Per metric ton in US dollar, $20 they have recommended for anti-dumping duty. Anti-dumping duty. Now look at this information, students. I have brought these notifications just to bring your attention, your interest on this less discussed, less read, less thought about topic called Customs Act. This Customs Act has so much of wide scope once you get into practice. Coming back. Anti-dumping duty as per General Agreement on Tariff and Trade. We call this as GATT. General Agreement on Tariff and Trade. That means to say, no one can wag their tail, or there is bylaws. There are bylaws which have to be abided by nations. Anti-dumping duty cannot exceed the margin of dumping. So when you want to levy anti-dumping duty, you have a free hand to levy that. But how do you levy? I have to identify something called margin of dumping. Up to maximum margin of dumping, I can levy this anti-dumping duty. However, lesser duty to remove injury to the domestic industry is permissible. So if there is an intention, if there is a recommendation which is less than identify margin of dumping duty, permissible. Every notification issued under this section shall, as soon as maybe after it is issued, laid before House of Parliament. Now please remember, the provisions of section 8 A, 8A, 9, 9A, 9AA, and yeah, these 4 sections. Always, whenever these provisions are invoked, they are placed before the Parliament. And if Parliament is not sitting, till the next session, the notification continues. And for levying this anti-dumping duty, they say, my anti-dumping duty shall be margin of dumping or injury margin. What is the margin of dumping? My margin of dumping is nothing but the normal value in that country and export value. This is a source point computation. Source point identification, where the notification says that in the country where the goods are manufactured, what is the normal value? What do you mean by normal value? The goods which are sold in that particular nation. That I compare with export price. In the given laptop example, $500 is the normal value and export value is $420. The gap between this $80 is called margin of dumping. Export price, construed export price. If not, these are procedural. I'll skip paucity of time. This also I'll skip for paucity of time. Injury margin. So what do you mean by injury margin? Injury margin means the margin adequate to remove injury to the domestic industry, which is computed as below. The fair selling price in the domestic industry compared with landed price. That means to say, this is source of destination. One is at origination, the another is destination. The initial I call as dumping, this I call as injury. So here, the fair selling price in the industry in India. So in India, assuming this laptop, if it is sold, the fair selling price in India is say $540. $540. And the landed price is $420. The gap between these two is $120. This is called my injury margin. So my anti-dumping duty can be either on the basis of margin of dumping or injury margin. One is at source, one is at destination. You as a customs officer, you can decide to choose either of these particular mechanism for the purpose of computation of anti-dumping duty. Now, exclusion. This anti-dumping duty is not generally applicable in case of imports by a SEZ or 100% EOU, unless there's a notification which says that even EOUs are subjected to this anti-dumping duty, or those articles which are manufactured by EOU are cleared to domestic tariff area. First, I import to EOU. From EOU, it is coming to DTA, domestic tariff area, or these are used in the manufacture of quantity in which are cleared to domestic tariff area. Imposition of duty with retrospective effect. They say that any anti-dumping duty I want to levy, from the day where I have brought this notification, I can travel in time 90 days, assuming this is my date of notification. I can travel back 90 days in time for levying anti-dumping duty. Imposition of duty with retrospective effect. This is an exceptional case. When I got to know that there is a dumping, anti-dumping which is happening, then I can bring a notification and I can travel back 90 days to levy this anti-dumping duty. Duty ceases to have effect after 5 years, which can maximum extend further for 5 years. Next. Section 9, I have talked about countervailing duty. This is countervailing duty for subsidy. This is countervailing duty for subsidy. This 9A is for anti-dumping duty. So, provisions of section 9B comes and says that no article shall be levied to both countervailing duty and anti-dumping duty. Examination, 1 mark, theory question for 4 marks. Examine the provisions of composite levy of countervailing duty and anti-dumping duty on a particular commodity. CA final. Expect the unexpected. You never expect that a one-line question can be asked conjoined to provisions. So here, 9B is like a big brother. So this provision says that no article shall be levied to both countervailing duty and anti-dumping duty to compensate for the same situation of exports of subsidization or dumping. So here they say you determine whether you want to levy under CVD or anti-dumping duty. I'll just pause here for a minute just to see if any questions are there so far. Mansa is asking this point. Dumping. Dumping is an example of mens rea. What is a mens rea? Mens rea is an intentional act. Mens rea, very neatly and nicely correlated, Mansa. There's a technical term called mens rea, MENSREA. Mens rea is an indication that there's a state of mind. What is a state of mind? Culpable state of offense. In the sense, there is an intent to evade payment of duty. There is an intent to do a wrongful act. So dumping is also as a mens rea. So your statement is valid, Mansa. We can refer to existence of an intent to do some wrongful act. Point number 1, 9B as a big brother says, both ADD CVD cannot combine together. Such articles are exempt from duty or taxes borne like articles when meant for consumption in the country of origin or exportation by reasons of refund of such duties or taxes. They say the articles or the goods, are exempt from duties or taxes. Exempt from duties or taxes. Borne by like articles when meant for consumption. In general, this is a statement that says, in general, any exemption notification, not specific. In case of dumping, the goods which are domestically procured to manufacture for the goods which are exported to India, then there is a subsidy. Then that is a subsidy. In general, if there is exemption notification, any goods which are procured for manufacture of so-and-so commodity which is exported, they don't say anything specific. I can import, I can procure locally, I can manufacture, and I export. Then I cannot levy anti-dumping duty, I cannot levy countervailing duty. Imports from member country of World Trade Organization or from a country with whom the government of India has most favored nation agreement. Point number 1, member country or member country of a World Trade Organization or from a country with whom government of India has most favored nation agreement. Most favored nation agreement, unless a determination has been made that import of such articles into India causes or threatens severe injury. There is a term called material in bold, material injury to any established industry in India or material retards to establishment of any industry in India. So in general, any countries of World Trade Organization or most favored nations, I don't levy anti-dumping duty, countervailing duty. Examination, please wait and watch. This section 9B is one favorite question for exam. Examine the provisions of the customs law in relation to levy of anti-dumping duty on a particular commodity exported from a member country of World Trade Organization. Or examine the provisions of customs law in relation to levy of a countervailing duty from a commodity imported from a country which is designated by government of India as most favored nation agreement. Most favored. I love this particular country. I appreciate, I support this particular country. So I designated that as a most favored nation agreement. So here, there's a material evidence, there is a material injury. In that case, I'll set aside this award, I'll set aside this member country certificate, I levy CVD, I levy anti-dumping duty. Next, social welfare surcharge. I think Arun was referring to this social welfare surcharge. This is like your income tax. We had this 4% sales, 4% cess. With an intent to encourage education and finance education, health and security, 10% is a social welfare surcharge, which is levied on basic customs duty. So this social welfare surcharge is on aggregate of duties, taxes, and cess, but excludes this safeguard duty, countervailing duty, anti-dumping duty, and social welfare surcharge altogether. What I'll do, I'll just insert one slide to give more clarity. Just give me a minute. For a moment, please keep in mind, social welfare surcharge is exempted on IGST and cess. Also, they say social welfare surcharge is excluded for computation of safeguard duty, CVD, ADD, and SWS itself. Safeguard duty, CVD, anti-dumping duty. Non-applicability of social welfare surcharge, SWS. I give a couple of examples. Examination, 4 marks computation. Say, I'll explain the problem in the series of calculation. I think there is a format in institute material. I'll just come to the respective page. It will be easy for you to understand. Yeah. Students, please come to page number 2.41. Page number 2.41. Institute material, page number 2.41. Hope you are able to see my screen now. Computation of customs duty and integrated tax payable thereon. Computation of customs duty and integrated tax. This is a format. Examination. Please wait and watch. 4 marks. Easy to score. Valuation chapter with this chapter. 6 marks is the scoreage. How to clear your exam? I'm giving a strategy. So for the purpose of customs duty calculation, I'll start starting point assessable value. This is under section 14. I derive something called assessable value. On this, step 2, I calculate something called basic customs duty at whatever percentage they have given. My assessable value into percentage. I call this as A. On step 3, on this basic customs duty, I calculate something called social welfare surcharge. So how do I calculate? Whatever basic customs duty is there, add social welfare surcharge at the rate of 10% on basic customs duty. This, whatever is there here, on that 10%, I apply on basic customs duty. This is called B. 10% of basic customs duty is my social welfare surcharge. Assuming 1 lakh is my assessable value. Assuming 12% happens to be my basic customs duty. 12,000 happens to be my basic customs duty. 10% of this basic customs duty is my social welfare surcharge. So this happens to be 12,000 into 10%, again 1,200. Value for computing IGST. So what I will do, I'll add 1 lakh, I'll add 12,000, I'll add 1,200. 1 lakh 13,200. This happens to be the value for the purpose of calculating IGST. Assuming my GST is at the rate of 18%. On this 1,13,200, I calculate 18%. And adding this plus this, I get my total customs duty. 13,200 plus 18% gives me my basic customs duty. Are you clear with this table? Are you clear with this table? I'll pause here for a minute. Let me know anyone wants this computation, this table to be explained again. Please confirm. Are we good to go ahead? Are we good to go ahead? Yes or no? Good. Let's come back. So here, so for the purpose of computation, I calculate my SGD, CVD, additional duty on the basic value directly. So here, assuming for a moment, one example, say my assessable value or tariff value, my transaction value. My transaction value is 1 lakh. My basic customs duty is 12%. Social welfare surcharge is 10%. Anti-dumping duty is 30%. IGST is 18%. How do we calculate this particular customs duty? To start with, I'll depend on a calculator for a few calculations. First, my transaction value, I'll say 1 lakh. On this basic customs duty at the rate of 12%, 12,000. On this social welfare surcharge at the rate of 10%, I'll add 10%, that is 1,200. Also, anti-dumping duty at the rate of 30% on 1,30,000. This is how I calculate my anti-dumping duty. Are we clear so far? Are we clear so far? Please confirm so that I'll go forward. Any doubts? Please let me know. I'll clarify once again. Any doubts? Okay. Now, till now, we did a basic calculation, which is called your duty computation. So I add all these components together. 1 lakh, 1,12,000, 1,13,200, 1,43,200. This is my transaction value for IGST. Transaction value for IGST. IGST at the rate of 18%. IGST at the rate of 18%. What I will do, I'll add 143,200 into 0.18, 25,776. 25,776. Add together 76, 976, 5 plus 3, 8, 4 plus 2, 6, 168. This is my value, CAF of imports. After duty, cost, insurance and freight after imports is 1,68,976. Are we clear? Any doubts? Let me know. Good. Let's go further. So this is how my social welfare surcharge says that in the process of calculation, social welfare surcharge is just a 10% levy on basic customs duty. And this social welfare surcharge is completely disconnected from safeguard duty, anti-dumping duty, and social welfare surcharge for itself. Again, for the purpose of IGST, my landed price, the transaction value, basic customs duty, SWS, CVD, SGD, or ADD put together is my transaction value. We're at 855, 854. Let me see any doubts further. Okay. Balaji says, sir, one more example. I'll explain this. Okay. One more example. Say there is a transaction value for rupees 35 lakh. There's a transaction value of 35 lakh. On this, basic customs duty is recommended at the rate of, say, 18%. 18% is basic customs duty. IGST is taxable at the rate of, say, again, 18%. There is a levy of countervailing duty at the rate of, say, 30%. Countervailing duty at the rate of 30%. This is what we were given. Please keep in mind, they may not make a reference to social welfare surcharge rate. By default, it is 10% on basic customs duty. So when I calculate this particular customs duty, I'll say transaction value 35 lakh. On this basic customs duty at the rate of 18%. Basic customs duty at the rate of 18%. So what I'll do, 35 lakh into 0.18, I'll get 6 lakhs 30,000. 6 lakhs 30,000. On this 6 lakhs 30,000, social welfare surcharge at the rate of 10%. That comes to 63,000. 63,000. Then I have something called countervailing duty, which is recommended at the rate of 30%. My countervailing duty is on the basic import value of 35 lakh, which comes to 10 lakh 50,000. 10 lakh 50,000. Are we clear so far, students? Are we clear so far? Good. So, for the purpose of the customs duty, basic customs duty is taken care, social welfare surcharge is taken care. And because there is a recommendation of CVD, I have taken that also into consideration. Adding all put together, 3, 6 plus 3, 9, 9 plus 5, 14, 4, 1, 6 plus 5, 11, plus 1, 12, 2, 1, 3, 4, 5. 52 lakh 43,000 is going to be my total price for IGST. Accessible value for IGST. On this, my IGST at the rate of 18%. IGST at the rate of 18%. $52 lakh 43,000 into 18%, 943,740. 943,740. 9,43,740. Put together, landed price is going to be 740, 86, 52 plus 9, 65. Total price including customs duty, countervailing duty, and IGST is going to be 61,86,740. And please keep in mind, AS2 inventory valuation, benefit of input tax credit can be taken only for this IGST, and this duty, whatever we pay, this is going to be our cost. This is going to be our cost. Countervailing duty on basic customs duty. No, answer. Generally, countervailing duty is levied on the price which has reached to the India. So basic customs duty is the basic. In addition to that, there is a countervailing duty. So law says that let there be a safeguard duty. Let there be anti-dumping duty. So my safeguard duty, anti-dumping duty, or countervailing duty, this is in addition to the basic customs duty. So I charge basic customs duty. I also charge this specific protective duty is on the assessable value which has been brought into India. So it is not loaded on basic customs duty. And moving on, classification of import and exports. This is not there in your syllabus. This is only for understanding purpose. When I look into my Customs Tariff Act, this Customs Tariff Act has got 6 rules in the sense how to classify a particular commodity. In addition to these rules, there are 3 explanatory notes where this explanatory notes gives how to interpret this particular Customs Tariff Act. And these explanatory notes and interpretation are integral part of your Customs Tariff Act. My first schedule has got 98 chapters and 21 sections altogether. Again, students, this is only for interest, not examination point of view. Just to have a reference, when you look into your tariff, there is a relevance in your tariff single dash, double dash, and triple dash. Single dash indicates that it is a description of an article. Double dash indicates it's a subclassification. And triple dash indicates that it is subclassification immediately to the main description of the single or double dash. And when you look into a particular tariff, I can refer at 4 level, 6 level, 8 digit level. And this is one extract from your tariff. 8402 indicates the chapter heading. 840219 indicates the subheading. And 84021200 indicates subheading to the main heading or subheading. So this could be called main heading. This 6 digit called subheading. 8 digit is called subheading to either main heading or subheading. This is how I identify my commodity in any particular tariff. And rules of interpretation, I just you can refer leisurely when you are interested how this classification is done. Couple of case laws in relation to classification, not relevant. Examination, they don't want to test you on any of these particular exemptions. And in eligibility of exemption to flavors, I think this is not relevant. I'll skip this. Students, with this, I'll come to the end of various duties discussed on chapter 2 of your study material, right? So hope you enjoyed today's discussion and also understood the concept of basic customs duty, safeguard duty, anti-dumping duty, and the protective duties. Also the big brother, which is covered in your 9B, where there cannot be a conjoint levy of anti-dumping duty and safeguard. With this, we come to the end of today's discussion. We will continue with our discussion on this Saturday in relation to valuation. Till then, good night, goodbye. Ashok?